for more on this whirlwind tour around the world. I'm joined by Saruhan Hatipoglu, the CEO of Beri Consulting here in Washington, D.C. Welcome back. Good to see you.
Hi, Phil. How are you?
So that was pretty good. We have a lot of numbers. I mean, the U.S., things are back on track. In Europe, the stuff about the euro is done. We're not crying about Greece anymore. Even in China, the service index, the manufacturing index, pretty much around the world, there's no recession. Everything's great. Are we looking at it the right way?
I will agree with you that there is no recession, but I'm not going to say everything is great. Actually, there are a lot of problems that not many analysts are looking at, because they're very happy that the recession is over. And I think it is. In the US and Europe, the recession is over. But don't forget, we have another debt crisis coming up in the US. We have Portugal, Italy problems coming up in the Eurozone. We have Japan's disagreements that have started in the central bank. That's going to come up. And China has a bank loan problem that is going to come up.
But can I say something?
Sure.
I mean, I knew you're going to sort of throw a little water on the idea. But could I say, despite all those problems, the U.S. debt problems, the dysfunctionality of what's happening in Italy, the uncertainty about China, despite all these problems, these numbers that we just talked about are on fire. I mean, it shows that the economy is resilient enough to keep moving forward despite the problems that you just highlighted. Isn't that a good thing?
No, it's a great thing. Don't get me wrong. We've actually talked a great deal with our clients today about those numbers, and they're very happy about it, and they're going to increase their investments based on those numbers too in a lot of countries. We are happy about it, but again, a lot of the data that we're looking at, they're coming from a very low base. So we need to wait for a couple of months, see if manufacturing is going to hold up. Look at employment numbers. They're not good in Europe, in the US. So we have to wait a little more.
But this is like buying stocks. I'm going to wait until the stock goes much, much higher, and then I'm going to step in probably at the wrong time. I mean, at some point, don't you just say, look, the problems are in the past. We're going to move forward. And if you look at the numbers aren't lying. There actually has been a trend. Unemployment is drifting lower. Europe is recovering. We've seen the GDP figures. All this call of disaster from economists, not necessarily you, none of it has come true.
Well, it is not a disastrous situation right now. And again, I'm very happy with positive data. But the problem is, Phil, let's look at the Eurozone, right? We're talking about it, and we're happy about the manufacturing data. But if you look at corporate loans, what's happening there? Banks are still not lending. Look at the unemployment numbers. We're talking about 12 to 15%. In peripheral countries, it's 20%. These are
What if they never lend again? What if unemployment just stays high forever?
Well, you don't want a jobless recovery. That's going to be a very bad thing, especially in Europe, when there's going to be also deflationary spiral that we're seeing. We didn't talk about the inflation numbers. They're not very good. There's a deflationary spiral that could come up. With jobless growth, that's not going to be good news, but I'm not going to ruin the party today.
Okay, I'm just playing devil's advocate. Are we more worried about things costing more money in the future, which is this inflation issue, or are we more worried about things costing less, which I don't understand how that's a bad thing if things cost less in the future. As a consumer, I want things to cost less. But of the two, which one is more of a concern to you?
Well, I think if we look at the inflation situation, if the inflation numbers don't go up, there's going to be a deflationary spiral. And if it is a jobless recovery, that's a very bad thing. In the U.S. too, and a lot of the central banks, Phil, are looking at the inflation numbers to ease up on their quantitative easing, QE, in the U.S., for example. If the inflation is not going to go up, they're going to continue providing the stimulus into the economy. And I don't even want to talk about the scenario where all of a sudden there's an overshoot. We're probably going to be talking about that in 3 to 5 months from now. But let's leave it at that for the time being.
But I have to ask you a follow-up on this. If the economy does better, they will raise rates, right?
Correct.
If the economy doesn't do better, they're going to keep rates low, which is ultimately good for the economy in the long run. So I still don't see how that would be a negative.
But if they continue, the reason that they're going to hold the interest rates low is because they're going to be providing more money, correct? And if you look at the 10-year treasuries, in the beginning of the year it was 1.3%, now it's 2.6%, despite all the monetary stimulus. So there's a risk premium now investors are putting on the U.S. We see that in Europe, we see that in emerging markets too, and that could, in the future, in the medium to long term, it could interfere with growth.
I'm going to drop Europe and pick up Asia.
Let's do it.
We have spent a lot of time on this slowdown in China, this hard and soft landing. The number doesn't perhaps illustrate how resilient the economy has been. Where are we now with China's economy?
China is China is going through a soft landing, and I think we talked about this before, and I'm very happy to get that right, because hard landing in China would spell out trouble for a lot of countries. But this last growth in China was driven by infrastructure spending again. Investment in infrastructure constituted more than 55% of growth for this quarter. And remember, China doesn't want that anymore. They want to rebalance. They want more consumption-led growth. That has not been accomplished yet, but it's not going to be the bad scenario that people were talking about.
Sure. I mean, the worst case scenario is off the table now.
Right. But next year, China's growth, I think, is going to be a little less than what we're seeing now.
And there's a big meeting coming up next week that maybe they'll help answer some of the questions.
A lot
that
of the
you,
questions,
you
liberalization,
just
financial market liberalization, sure. There's going to be a lot of discussions, reform discussions in that meeting.
Saruhan, great to have you here on the set.